All right, so we're going to start with chapter two. At the end of your chapter, there are discussion questions. And so I just thought I would kind of go through those as a means of helping you review the material in the chapter, as well as just kind of bring some things together that you might have missed. So I did post the slides for these, so you're welcome to either put those down, download those on your computer, or print them out and write them out as I'm going through these questions as well. So in this review, we're going to do questions 1 through 9 of chapter 2. Chapter 2 has 31-ish discussion questions, so this will actually be broken up into 3 different parts. I don't know exactly how long each one of these reviews will go, so I wanted to break it up into sections. So let's go ahead and get started. So first question, describe the personal risk management process. So when we're doing this, we're wanting to do a couple of things. Get a pen going here. We want to identify, we want to evaluate, and we want to manage the risk exposures that clients face. Okay, and the chapter talks about a 7-step process. That is not how you spell 7. All right, so the first thing that we want to do is we want to determine the objectives of the client. And then we're obviously looking at this from a risk perspective. All right, number 2, we want to identify the client's risk exposure. Okay, what are they exposed to? What are some things that they may have in their life? Next, we want to evaluate the identified risks for the probability of occurrence. We want to identify the probability of occurrence, and we want to look at the severity of loss. All right, number 4, we want to determine alternatives. So what are some things that the client can do to perhaps alleviate some of these risks? Next, we want to select alternatives. You'll have to forgive my handwriting here. All right, and then number 6, we want to implement the risk management recommendations. So once we have a chance to identify the alternatives, we want to come up with what are the processes that the client should be looking for. And then we want to review the risk management program. Okay, so just kind of recapping on this, we want to describe the personal risk management process. The idea behind all of this is we want to identify, evaluate, and manage the risk exposures for a client. And the 7-step process is that we want to look at the objectives of the client, again, from a risk perspective. What are they trying to accomplish? We want to identify the client's risk exposure. We want to identify the probability of occurrence and the severity of loss from these risks. We want to select alternatives. We want to determine alternatives, select alternatives, implement the risk management recommendations, and then review this on an ongoing basis. Okay, next question. List the 4 responses to managing risk. Okay, so number one, we have risk avoidance. Okay, and in this situation, we're just basically avoiding the activity. Okay, all right, number two, we want to do risk reduction. And here, this is going to be just implementing activities that can reduce the frequency of severities. So implement activities that reduce the frequency or severity of the loss. All right, number three, we want to look at risk retention. Risk retention. Okay, so basically, we are going to be taking responsibility of that loss exposure. And number four, we are going to be looking at risk transfer. Okay, and this is basically removing the risk to another party. And if you think about the basic concept, let's just use life insurance as an example. The risk of life, the risk to an individual is dying before you have sufficient financial assets to cover all of your future expenses. And therefore, when you buy life insurance, that risk of not being able to pay for all of those future expenses can be moved to an insurance company. So, risk avoidance, risk reduction, risk retention, and risk transfer. All right, number three, define a PEARL. This is defined as a proximate or actual cause of loss. Okay, so for example, what is a PEARL, for example? Sickness. That could be an example. We could have fire. We could have a windstorm. Okay, so these are going to be the causes of a loss. Pretty straightforward. All right, number four, define the three main types of a hazard. So we have a physical hazard, and this is a tangible condition. So, for example, icy roads. Okay, so that is a physical hazard. Okay, and then we have moral hazard. So this is one. Okay, and this is a character flaw. And this would be, for example, lying. Okay, being dishonest, anything that then could cause someone to make a decision and then create a loss because of that. And then we have morale hazard. And this is basically being indifferent. Let me just start over here. Indifferent to losses based on the existence or having insurance. Make sure I can give you guys actual words are okay. So we've got these three hazards: physical, moral, and morale. All right, number five, list some unique characteristics of an insurance contract. Okay, I will go through a few of them, but may not hit all of them. So just make sure that you're going back through and reviewing these. All right, one of the first components is that it is unilateral. Unilateral basically means that the insurer is making a promise and they're the only ones making a promise. Okay, so therefore it is a unilateral contract. There's only one party making a promise. Aleatory. Make sure I spell that right. Aleatory. This is the fact that there is not going to be an equal amount between the insurance company and the insured. So what is paid in by the insured for their premiums and then what is paid out by the insurer are not always going to be equal. In fact, in many cases, there's never a payout from an insurance company. So, for example, in term life insurance, you may pay on that contract for 20 years and never receive anything from the insurance company. Okay. Next, we have adhesion or adhesive. This is the idea that the insurance company had no opportunity. Let me start over. The insured had no opportunity to negotiate any of the terms in that contract. So, for example, when you get a contract for life insurance from an insurance carrier, you don't have the opportunity to make any changes to that contract. And because of that, if there are any ambiguities, any things that are unclear, those are typically going to benefit the insured. So that's the idea of adhesive. Okay, we also have what's called utmost good faith. And this is the idea that the insurance applicant is being truthful in their disclosures of all material facts to the insurer as they are beginning to underwrite the insurance. Okay, so there is this idea that when you are the insured and you're applying for insurance, that you are giving them pertinent material facts, obviously not lying. There is also the principle of indemnity. Okay, and this is basically that the insured, you, the person buying the insurance, cannot make a profit from a claim on insurance. Okay, so you can't buy insurance with the ability then to make additional money. Okay, all right. Next, we have you must have in most cases an insurable interest. Okay, this means that you have an interest in the individual or property that is being insured. Okay, now we'll talk about circumstances when that has to occur at the beginning, but then if that insurance is transferred, that insurable interest may not apply, but the insurance can still exist. There are certain insurance, though, that as long as if the insurable interest is no longer there, the insurance is no longer available. And typically we have coverage of insurance is conditioned upon premiums paid. Okay, so the insurance coverage must be based on the fact that you are making your premiums. So as soon as you stop making premiums, then that coverage can get canceled. All right, let's move on. Okay, number 6. Question is, explain the differences between pure risk and speculative risk. All right, pure risk. Basically, what this means is that there is a chance of loss or no loss. Okay, so you have one or the other. So something is going to occur or something is not going to occur. So that is a pure risk. There is no chance of experiencing a gain in pure risks. So, for example, you're either going to be alive or you're going to die, but there's no gain. Speculative risk, there can be a gain, loss, or chance of loss. Okay. Speculative risk is the risk that an investor takes, for example, when they buy a stock or perhaps someone wanting to start a business. They can lose, they can gain, but there is a chance of loss. All right, let's move on. Number 7, explain the 4 differences between subjective and objective risks. All right, so subjective risks are risks an individual perceives. Okay, remember this is based on our prior experiences. Okay, and it will also be based on the severity of our experiences. For example, a car crash, right? We could have had a small fender bender, but we could have also been in a very severe car crash. And the individuals and these perceived risks, individuals perceive them differently, um, and our behavior will depend on how we perceive those risks. Okay? So if an individual perceives something to be high risk, then the individual may take steps to reduce that risk or perhaps avoid that risk. Objective risk might be classified as not um, meeting some sort of expectation. The variation of actual losses that occur over time to the expected amount of losses. So um, we have our expected return um, and minus our actual return. As the number of the loss exposure increases, that objective risk is reduced. So for an insurance company, as the number of loss exposures increases, the results, will begin to equal the expected claims. So objective risk varies really indirectly with the number of loss exposures in an insured pool. So the number of loss exposures varies indirectly with the insured pool. Okay, let's move on to number 8. Okay, describe the law of large numbers and why it is useful for insurance companies. So basically, the law of large numbers is a principle that states that actual outcome will approach the mean probability as the sample size increases. So think about this. When you ask someone to flip a coin and you say, what's the probability that it's going to be heads or tails? And they'll say, well, it's 50%. That is true when you take into consideration the a lot of coin tosses. So if you were only to do it three times, it's very likely that you might get three heads or three tails, and therefore it's not 50%. What you would get in your answer is not 50%. But if you were to do it 10,000 times, you would end up with something very close to 50% heads and 50% tails. So it's just saying that as those numbers get larger and larger and larger in our data set, we are going to approach the mean probability. Okay, last question for this set is list typical perils covered under a personal auto policy. So some things that we would see would be fire. If your property was damaged in a storm, we have things like theft, collision, we have hail, flood, for example. We have falling objects, earthquake. And last, I'll put on here windstorm. Okay, so 9 different perils covered under a personal auto policy. All right, so that wraps up this first part of Chapter 2 discussion questions.